found this stock in the beginning of 2000s and he bought his first share at 4 rupees. He liked this company so much that he bought 23% of the entire company. 2022, it peaked at around 2,800 rupees.
How would you define the right time and the right valuation?
The market doesn't care when you put it in. It can be violent, but the aim of the game is to pick certain numbers of stocks that you hope have been overlooked by the market. Many times you've seen it go up and then it comes back to zero and it may even go negative and you say, I would have, should have, could have. We have the largest population in the world. We have a young population, whereas China, as you know, is aging. All these things are long-term tailwinds. They're not near-term, not passing phases. They will be with India for 10 to 20 years. When you look at America, for instance, it's a very hollow market. We're like 5 Americas. The government has ring-fenced around $2.7 trillion to infrastructure spend. That's a big number. That's bigger than most countries' economies. China plus one is another inflection. We will at least double our capacity within 10 years what it took 74 years. So that's structural growth. I mean, you have to look at the whole shebang. Why is a stock cheap? It's because people just don't like it. You can't be fazed by price movement. We like to do what we know. You know, like Peter Lynch says, do what you know.
Hot topic, AI.
The right prompts. It can even start doing valuations. We're examining that element. Can it really be a contrarian player? Can it deal with a COVID situation, a pandemic? What will it do with Donald Trump and his tariffs? You're reading here and there, using AI, maybe what shall I buy? You're competing against someone who has a team of analysts. I think today everyone wants to come and they want to be Gordon Gekko. They come straight from the block and they want to be the Wolf of Wall Street.
You are picking a stock. What is your thought process in it?
Wow, that's a good question.
Value investing versus momentum investing. How are they different and which one do you prefer more? What are the top 3 red flags that you would see in a stock?
You're continually just digging and digging.
You're stealing your star recipe. Before we dive in, I want to take a moment to thank our venue partner, On the Road Specialty Cafe here in Alcuz. They've been kind enough to host us and honestly, it's one of the favorite spots in Dubai. They're all about quality coffee, a warm community vibe and creating a space where people actually want to slow down and connect. So if you're in Alcuz, definitely stop by, grab a coffee and experience it for yourself. Huge thanks again to On the Road Specialty Cafe for being such a great partner and for supporting Unfiltered Investments. Hi everyone, welcome to the next episode of Unfiltered Investments. Today we have Mr. Arun Chulani from First Water Capital. He is someone who's studied Indian equity market for years and he has a very disciplined and practical approach to looking at companies and doing value investing. What I love about Arun is that he explains everything in such a simple manner, no jargon, no complication, and he will get you hooked to the market like no one else. So let's dive into this episode with Mr. Arun. Hi Arun, thank you so much for joining us today. I'm super excited to be doing this episode. I've heard so much about you, but I first want to know, how did you end up doing what you do today?
Wow, that's been quite a journey. I graduated a very long time ago. In 1998 and yeah, exactly.
I wasn't even born then.
Oh, well, anyway, lucky you. So essentially I graduated from the London School of Economics.
Okay.
I went to Arthur Andersen, which at the time was a pretty decent firm, and I did 3 years there in their audit practice. So I did my chartered accounting and whatnot, but it was a beautiful space to really train. Get to know accounts, get to know different industries, actually go to the factories, go to the warehouses, speak to people on the ground. And there is a tangible way of seeing and understanding businesses, as well as doing the CA on the side. You very much know how to break up financial accounts, look at financial performance, see where management may adjust or put in bias, and also question them to say, how do you taper it down to make it more realistic? So it's very interesting, let's say, training ground. After Arthur Andersen, post my CA, I went to Lloyds Bank, which is one of the biggest British banks. I was in their treasury department, so looking at FX, looking at bonds, looking at liquidity, a very interesting training ground as well. Post that, I went to Ernst & Young, so back to practice, where I joined their corporate finance division. I was involved in restructurings, M&A, due diligences, so a whole bunch of things that really involved, again, looking at different industries, getting really into the nuts and bolts, speaking to management, actually visiting the sites. And again, it was a very enjoyable opportunity to really learn about businesses and business analysis. Post that, I went into private equity. So here was a bit different. I went from very much a sales role and one where you do projects for, let's say, 2 to 3 months and then you move on, to one that you're actually an owner. You're an owner of these businesses. You are here for the long term. So very much, it was a very beautiful experience where I looked at industrials. So for instance, petrochemicals, oil and gas services, chemicals themselves. So various businesses in the industrial space. And yeah, I had a great time. It's always nicer to be on the other end when with the budget in hand, with the money in hand, and actually have people feed opportunities to you and really kind of filter through them and trying to understand them. But then I pivoted. So I went from private equity, and then in 2018, we went into public equities and public equity in India. And this was like a better business model. Why did I do this, essentially? Essentially, I met a gentleman who's the main guy of this business, a gentleman called Chulani. And he's been in the Indian markets for about 30 years. And I'd always heard he's done a pretty decent job, but people usually say these things in bull markets. So very much they're always a bull market specialists. So you don't know what happens in the bear market. But I re-met him and I said, and he said, Arun, what are you doing? I said, I'm in private equity. I thought I'm pretty cool. And he said, whatever you're doing, it's rubbish. And this is what I do. So essentially, he went into his investment philosophy, how he invests, his approach. He's not looking for like upsides of 20, 30%. You know, often we're conditioned. We come out of good schools, good universities, and we read a report, whoever it is, I don't want to name, some investment bank, and they say, buy the stock, it's going up 20%. Sell the stock, it's going down 20%. And very much he said, I'm not interested in 20 or 30%. I'm looking for multiples. I'm looking for 100, 200, 300%. And this is what I'm really looking for. I'm also looking for concentration. So if you really like a stock, you really like an idea, you want to take a big swing at it. And that's his approach, his philosophy. Fortunately, he's very much in the same businesses that I was looking at in private equity. So in packaging, in chemicals, petrochems. And essentially, so I went back. I was obviously puzzled. I said, you know, I just met him a couple of times and it was like, wow, this is like mind-blowing. So I went back, I reproofed. And really, based on my very rudimentary at that time thoughts and understanding, I really saw there was significant upside on many of these stocks that he was talking about. So I put my money in. And luckily, it was 2016. Oh, wow. So 16, the world had blown up. In fact, there was this equity analyst report that came out in, I think, January 2016 that said, by RBS, I think, it said, sell everything and the kitchen sink. But from that day on, the market just went one way, upwards. Ooh. So had you sold this kitchen sink, you wouldn't be washing your glasses or plates in anything. So it'd be a very sad day for you. But luckily, we didn't, and the market went up. And these stocks actually proved it. Like they went through multiples, whether it was a company called Rain Industries. He identified it at 35 rupees. In 2018, the beginning, or 17, it peaked at 470. So this was like mind-blowing. And so I was super hooked. And I used to meet him every month. I'd just like call him and say, what's happening? How are you approaching it? And I really just wanted to learn. You know, a lot of the time, you know, everyone graduates from university and everyone wants to be either George Soros or Warren Buffett or the next big thing. But many times they join a franchise. They end up joining a decent franchise, whoever they may be, an investment bank, and then they just sell the franchise. They're now led by fee incentives, how to sell things, how to close deals, how to push a stock. But they end up losing that kind of direction that they wanted to create alpha. But this guy is a man who's really developed alpha. And you know, it's like me being a very average club tennis player and Roger Federer saying, I'm going to teach you how to play tennis. Immediately, I'm in. And in 2018, he said, look, if you really want to learn, let's start something. Let's start up a structure, an investment structure, and then let's build a real fund. And I want to institutionalize. This is a man who doesn't need to institutionalize. He's just a one-man army. And I'll go into this in further detail. He's just a one-man army, but he said, I want to institutionalize. I want to pass on my process, my investment philosophy beyond me. And that's what we did.
Wow. So you changed your entire career based on this one guy.
Exactly.
And where is he now?
Yeah, so he's leading the fund.
Okay.
And we're doing a pretty decent job.
Okay, that's really nice. So I want to know, were you like born and brought up in India?
No, I'm born in
Okay.
London.
Okay.
I was schooled in London, and I went to boarding school at the age of 8 because my mother, she said, this guy's too messy. I've got to get him disciplined.
Yeah.
Boarding school failed. I'm still pretty messy. But yeah, that's where I was.
So did you have any bias towards Indian equities before, or was it the first time while you met this guy?
It was the first time, actually.
Okay, wow.
I mean, I'd known of it. I'd kind of dabbled, but with no real intent.
Okay.
But this, seeing his thought process, then I was hooked. Everyone hears of things, and it's just like bubbling in the sideline. But when you get really explained, and when you really accept that explanation, that's when opportunity comes across.
So I think that's exactly what we want to do today. Even if we learn like 1% of what you know, it's going to be great for us. To begin with, I want to know, how is Indian market different from markets outside like US, Europe, or China? Because I know China and India is like a big debate now.
Yeah.
So how would you differentiate it?
Well, India in the last, let's say, 20, 10, and 5 years is one of the best performing markets.
Okay.
And it's a broad-based market. Whereas when you look at America, for instance, it's a very hollow market. Because if you're not in the top 7 stocks, the Mag 7, then you're nowhere generally. Effectively, it's not broad-based. Because one is, it's a mature economy. It's growing at 2-3%. It doesn't really need that much. While they say American infrastructure's crumbling and whatnot, but at least it exists. So it does need an upgrade, but it exists. People do have affordable housing. They're generally rich, or at least middle class. So many things have been achieved. It's very much a new economy, which is pivoted towards financials, pivoted towards tech, whereas the base, in terms of your base needs, have been already built and are already existing. Whereas India is very much in the beginning, or not in the beginning, but during its journey of the old economy, maybe where China was 20 years ago. So we have the largest population in the world. We have a young population, average age of 29, whereas China, as you know, is aging. If not, the population is decreasing. If you look at Japan, again, aging. Europe, aging. America, probably aging. So many, what happens then? That means more people are coming out of the workforce and are being forced, the younger generation who's in employment are now forced to support them. So effectively, and so the economy isn't growing due to the people or the growth of people, whereas India is growing. We're 18% of the world's population. And plus, we are in old economy stage, as mentioned. So whereas China you see today, it's growing at, let's say, 5 or so percent, but that's because it's now transitioning. It's done an economic miracle. There's no doubt about that. At the beginning of the century, it has brought its people from poverty to low middle class. So if you look at the late, let's say, the late 1990s, India and China were neck to neck in terms of GDP per capita, maybe $1,500, give or take. But now China's at $12,000. India's still at 2.7. So that's a huge difference, isn't it? But now that means that they're lower middle class. They are mature or maturing. That means where they had labor competitiveness, they are no longer labor competitive. So effectively now they have to transition. So what has brought them up can no longer allow them to continue to grow effectively. So they have to now transition to a domestic economy, to consumption, to services, to value add. And obviously, as you can see now, that is the harder part, whereas India is not in that position. We still need infrastructure, affordable housing, consumption, even toothbrushes or food or branded goods, that we're still at the, let's say, at the early stages of our economic revolution.
Okay, so like let's say you spoke about the demographics, right?
Yeah.
Like the age of people, the average age of people. How big is the impact on the GDP or the growth of the economy of that specific country?
Of course, it impacts, on a quantitative level, I can't tell you, but of course, as people enter the workforce, they become productive.
Okay.
So the more productive people are, so India has 55% of our population between the ages of 18 and 55.
Okay.
As mentioned, 29 years. So the majority of our population is able to work. So, whereas if you're in Europe or China, these guys are dropping out of the working population. So now they need the state to support them in many cases. Whereas now you've got an inverted triangle where you have a lower base needing to support a larger aging population, whereas India is now a pyramid still. So you have a younger population who's able to support the aging element. So it's more productive as you're a younger population.
But do you think India has enough jobs or opportunities for that younger population? Because I see a lot of people moving out of the country. So why is that the case?
It's a hard question to do.
Okay.
It's a hard, let's say, aspect to look at. Of course, there's high youth unemployment in certain places. And it's not so easy. This government has to look after 1.4 billion people. There's going to be areas that it's unable to match at a certain point of time. But over time, this should hopefully be absorbed because we're like 5 Americas. We have a large middle class, whether it's, our middle class will grow. Currently, it's around 400 million. By the end of the decade, it should be about 700 million. So that's another America of middle-class people growing within a single country. And yes, to get people jobs, it's not so easy, like to make the right decisions, to create the right ecosystems. Everything needs time, but hopefully this will happen over time.
As a foreigner, right, what do people usually misunderstand about investing in the Indian market?
So as a foreigner, there are 2-3 aspects that people probably don't look at. Everyone thinks depreciation, the currency is depreciating, how will that impact my returns? And of course, India is depreciating at around 3 to 4% annually a year. And but the stock market effectively is very much a decent hedge in many respects, whether on industries at least, because many of these industries are tollers and they use dollar-denominated raw materials and they sell in dollar denominations, a very long word. Essentially, so whether you look at chemicals or petrochems, it's oil related. So again, dollar denominated. And when they sell it, they refine it and then they sell in dollars again. So very much it's a pass through. Then plus the balance sheet. Where do they get their machinery from? Usually they'll go to Germany, they'll go to America, they'll go to Japan or China. They buy it in dollars. They bring it back to India. And just because the Indian rupee is depreciated doesn't mean that the machine has depreciated because it's still dollar denominated. So very much the balance sheet as well as the actual products are dollar denominated. So that's one element. 2 is the volatility. India for sure is a pretty decently volatile market. But which market isn't? If it was so easy, if every stock market was growing at a linear rate, then how do you create alpha? Stock markets are volatile, but that's the opportunity. So many times people say flight to safety, got to get out. But effectively, that's your opportunity to buy the same business at a better discount.
So you keep talking about alpha a lot. How would you define alpha?
Well, alpha is how much money can you make over and above the benchmark.
Okay.
And not even on time weighted. A lot of the time people look at time. They say, how much have you made over a year, 2 years, 3 years? But really they should look over capital weighted.
Okay.
At what time or how much have you made on a dollar basis as you've entered the market?
Could you break down time weighted and dollar weighted?
So time is measuring your performance over a period of time. So let's say, how have you done on a 1 year, 3 year and 5 year rolling basis? Okay. So that's time weighted. But on a single dollar, at that point of time, what is your NAV achieved? Okay. But if you look at capital weighted, let's say you have $10 million and you put in $500,000 5 years ago.
Okay.
But the market has gone up significantly. but you put the rest of your $4.5 million last year, and the market has fallen 10%. So effectively, you've actually lost more money than you've made because on a capital weighted basis, you've lost more capital. So you have to measure it against capital because that essentially is really what counts.
So why do people not use capital weighted so often?
I think it's harder, and it's probably easier to compare when they look at different funds.
Okay, fair enough, makes sense. Now in India, people, like at least retail investors, right? They know a lot about mutual funds, SIPs and funds, something that you work in. Could you tell us the difference between all of them?
Well, mutual funds are very much with the big houses.
Okay.
They usually have a big corpus, but also they're usually pretty well diversified.
Okay.
They're in trust structures, and I guess they are mainly for the masses.
Okay.
For the retail investor, you can still SIP, which means systematic or systemic investment program, where you put it in a disciplined approach, let's say monthly or quarterly. And they're more heavily regulated and they have strong compliance.
Okay.
Whereas, let's say, an AIF or an investment fund, there's a lot more discretion to the manager. They can be more concentrated. They can take concentrated picks on a single stock. Because if you have strong conviction, let's say you're looking for multiples, 100, 200. If you have strong conviction on a single stock, you don't want to be 2%, because even if it doubles or triples, what is the real impact? Not too much. So here you're really backing someone who feels that he can create alpha, essentially, over and above. Of course, the mutuals can, but because they're more heavily regulated, because generally they're more diversified, effectively, they're unlikely to really be able to back strong conviction.
Got it. So when someone does or signs up for an SIP, they are essentially investing into mutual funds itself.
Yes.
So SIP is just a structure.
Yes.
Where you either invest monthly, quarterly, or however you would decide to do it. Okay. Whereas in fund investing, how often do you put your money in? Is it like a one-time thing, or can you keep doing it? How does that work?
Investors can do it to their discretion, but how we advise or suggest to people, and of course we reserve the right to be wrong, is to have the SIP approach.
Okay.
Because let's say someone had $10 million and he goes, here it is today. Then he's speculating. He's speculating that the market can only go up. Or, if at all, the market can correct maybe 10% within his pain threshold, and then will continue moving up. But as you know, the market doesn't care when you put it in. It can be violent. It can go 20, 30% quite easily. You know, when the conflict happened, the market fell. When Donald Trump announced his tariffs or Liberation Day, the market fell quite violently. So you may have put your money in just before, and then you'll be thinking, I've lost a lot of money quite quickly. But how we suggest is to adopt the SIP scheme. Because that's really your weapon against near-term volatility. So let's say you did have this 10 million and you say, I'm going to put in my initial tranche, a foothold in the market, 20 or 30%. And if the market moves up, then you're confident to continue putting in your money because you've gained from your initial tranche. But let's say the market falls, then your next tranches are very much your weapon against downside volatility. Because a lot of the time, hopefully, it's very notional and it's temporal. It's not a structural downside volatility. So that way you are averaging your loss in the market as well as your time in the market, which is equally important.
Okay, so now we spoke about a lot of terms. I'm going to break each of them down. You spoke about downside volatility. What is downside volatility?
So when the market falls, and that's volatility or downside loss, let's say.
Okay, so downside, just the downside loss.
Yeah.
Okay. Then you spoke about concentration.
Yeah.
Right? So concentration essentially is something that is not diversified, but bets that you're making against the market, essentially, right? How does it work in terms of risk return profile for an index fund versus a concentrated fund?
Sure. I mean, what is a stock picker or a fund manager achieving to do? He is trying to achieve alpha.
Okay.
And how do you achieve alpha is how you beat the index, as mentioned. But you can't beat the index if you are the index. So if you pick the same sectors, same stocks as the index, you're pretty much just going to be an index hugger. But the aim of the game is to pick certain numbers of stocks that you hope have been overlooked by the market, that will essentially beat the market in terms of performance. So what do I mean by concentration? So effectively, the market is pretty smart. It's not that it gives you a lot of opportunities, but occasionally there's a handful of stocks that are being overlooked that can create that alpha. So if you have a strong conviction and you say, okay, it's been overlooked, I can back the house against this. Obviously, you don't want to go overboard, but I can put maybe 10% of my AUM on this stock because I believe that there's going to be an inflection, there's a near side inflection, and if this happens, then it's going to impact earnings and it's going to move up.
When you take a bet on a company, right, how much maximum percentage of a fund do you put in a single stock?
Up to 10%.
Up to 10%.
Yeah,
okay.
because again, you don't want to go overboard.
Okay.
Because essentially you are dealing with other people's money.
Yeah.
You still got to be cognizant that you could be wrong. So you want to be diversified, but you don't want to be over diversified.
And when you buy or you sell, right, within what time frame do you buy and sell?
You could hold a stock for 20 years. You can hold it for 2 months. Effectively, we're active managers.
Okay.
And we're not in the camp that says buy and hold, buy today and sell in 15 years. Because essentially the market and being diversified gives you opportunity. Because when you put together 30 to 35 different stocks in your portfolio, you don't know who's going to move up first and even who's going to move down. Because the market can move on its own accord in the near to medium term. But that gives you opportunity. Because as some stocks move up, as long as the business case is still the same in all your portfolio, you may choose to trim it. That way you're killing 2 birds with 1 stone. You are de-risking, and then you can rotate capital into the laggards because you're effectively skewing the asymmetry of risk and return into your favor.
Yeah, so this is basically rebalancing.
Exactly.
So if something goes up beyond your 10% threshold...
Oh, not even 10%. You just do it, you may have 3% in a stock.
Okay.
But even if it goes up, let's say 20 or 30%, we tend to de-risk. Because many times you've seen it go up, and then it comes back to 0, and it may even go negative, and you say, I would have, should have, could have. But you've just got to have that discipline to trim it.
Okay, got it.
And then you say, what do I do with this capital? Where is a better place within my portfolio? Or is there a new opportunity? And then you rotate it. Maybe one stock that you feel strong conviction has fallen 10, 20%, because that's just the way of the market. You may relocate or reallocate that capital into that stock.
Okay, got it. So let's say this depends on the performance of the stock. You have no certain time period so as to how you are
no,
making
not
these
really,
decisions.
because I mean that's the thing of being a long only fund manager.
Okay.
And of course, bull markets and bear markets tend to last for about 2 to 3 years. So you have to have that mindset that you can sit it in for 2, at least, let's say 3 to 5 years.
Okay.
That you can sit in. Like when we started, was one of India's longest bear markets. 2018 till COVID. You know, first of all, India was growing at 5%, so that everyone thought, what's happened?
Yeah.
2, we had come off a very strong bull market, 16 and 17.
Yeah.
So again, the market was consolidating and even going into that bear phase. So many things were going against India. 3, we had a liquidity moment where a very large government quasi financial institution went under due to corporate governance issues. So there was a liquidity freeze. Many things went against. And then along comes COVID, which again hit the market. So you've got to be able to withstand time. And just hopefully, if your structure is in place, your inflection's in place, you've bought it at the right valuation, hopefully that comes through in the end.
Got it. You spoke about buying at the right time or at the right valuation.
Yes.
How would you define the right time and the right valuation?
Time, again, you don't know.
Yeah.
But I mean, obviously you're looking for inflection points. So it could be the turning of a business cycle.
Okay.
So you're looking for green shoots. So, you know, businesses don't go up in a linear way. They're business cycles, because when demand is strong, when margins are strong, what happens? Usually people put in capacity and then suddenly supply catches up and sometimes takes over. And that's where the business cycle turns.
Yeah.
But the beauty of India is it's growing at about 6, 7, 8%. So hopefully that demand catches up faster than usual. So again, the market cycle turns again as your demand catches up. It could be a government initiatives. So what do I mean by this? The government has let's say, ring-fenced around $2.7 trillion to
Okay.
infrastructure spend. That's a big number. That's bigger than most countries' economies. So, and it's happening, whether it's roads, airports, bridges, the railway, defense, all this is government infrastructure spend. So you would be looking at that and saying, okay, what's cheap at that time, and where's the money going to be budgeted effectively? It could be China. China, as I said, has achieved, and they have a lot of capacity. So there could be this anti-involve where they say we're going to let some market forces come into play because we got too much capacity. And how long can we import pollution and export cheaply? How long can we keep unprofitable companies bumped up? So let the market decide who the winners are. So when that happens, they will start to reduce volumes.
Okay.
They will start to reduce capacity itself. And who's hopefully going to be one of the gainers? It's going to be India, because we are growing as a nation. So essentially, whether it's refineries, whether it's aluminium, whether it's steel capacity, China is looking to reduce all this, or cap it at least.
Okay.
And again, China plus one is another inflection. So what do I mean by this?
Yeah.
You know, China has weaponized its supply chain. It's weaponized rare earths manufacturing. So if you're a person, a nation, you don't want to be so reliant on a single country. So again, this is another inflectional catalyst that we have looked at, where businesses are looking to diversify their supply chain. And where else bigger than India to diversify to?
So why is China trying to cap it? Just because they don't want to be heavily reliant on it?
Exactly, it's polluting. And yeah, essentially it's polluting, and that's the main reason.
So are they going into other industries, or how are they trying to manage it?
Well, yes, they are going into, they're trying to upgrade, aren't they? So from raw, let's say, commoditized type businesses, they're trying to do more value adds. So
Okay.
rather than just steel, they go into cars. Rather than just selling plastics and petrochemicals, they're trying to go down the value chain, because that's where you get higher margins.
Oh, okay, got it. What about India? Right now, where is India at in this value chain process?
Well, we're still at the beginning.
Okay. So
So-
we are expecting to see the massive growth that China has.
Exactly. So,
Okay.
so look at, for instance, steel production. Ballpark, there's about 2 billion tons capacity around the world. Who has the biggest? China. It's 50%, close to 1 billion tons of steel capacity. Who's number two? India. But where are we? We are at 140 million tons. Look at that quantum difference.
Yeah.
But they don't need so much steel capacity because they have a property construction issue. And again, it's polluting, plus it's a low value add. So they themselves are saying, we've got to transition. We have to reduce our capacity because it's not a good use of capital. So they're looking to reduce capacity. So even if they reduce by 10%, that's almost as big as us. They're 100, almost as big as 100% of India's capacity, or let's say 70%. So what does that mean? That means volumes will come down. So if your biggest competitor around the world is trying to reduce capacity, we have that opportunity to pick up our volumes as well as our margins, which is as important. And India itself is growing, whether it's our construction, our infrastructure, our affordable housing. All this needs steel capacity. And in all honesty, we are doing it. So let's say, look at the turn of the decade, 2020. We had 100 million tons of steel capacity. So that means ever since the British left 70 whatever years ago, 76 years ago, or 74, it took 74 years to build 100 million tons of capacity. By the end of the decade, it's expected that we should have 240 million. So we will at least double our capacity within 10 years what it took 74 years. So that's structural growth.
So let's say when you're picking a stock, right? I've heard a lot of people talking about PE multiples or growth ratios or things like that. So do you also look at these technical terms, or if you are picking a stock, what is your thought process in it?
Of course, it's very important, because
Okay.
what are you trying to do essentially is you're trying to mitigate your downside and maximize your upside, or at least skew the asymmetry in your favor,
Yeah.
because you may be wrong. So you may say, well, what's the maximum I can lose? So that's very much in the valuation. You want to hopefully come in at a decent valuation. And we are very much in the manufacturing world. So for instance, what do I mean by cheap valuations?
Yeah.
Today, the index is at 3.7 times
Okay.
price to book.
Okay. So what
Our-
is price to book? Let's break
Oh,
this
okay.
down. Yes.
So price to book is
Sorry.
where its book is its balance sheet, its net assets.
Okay.
So what's on a balance sheet is assets, liabilities. So what is the assets minus the liabilities?
Okay.
Is essentially the net assets.
Okay.
So maybe this stock has a balance sheet net assets of 1 billion and the market cap is 2 billion. So
Okay.
that means 2 times price to book.
Okay. So 2 billion is the market cap and book is the net assets.
At 1 billion, so that will be
Okay.
2 times price to book.
Got it. Is this a good, like 2x, is it a good number or
Oh,
not?
it depends on the business.
Okay.
If
so,
it was Amazon, it would be an excellent number, but you would
Okay.
be a bit wary, obviously.
Okay.
But if it's the industrial, then of course it's a bit different.
Okay. So we have price to book. What else do you look at?
So we look at price to earnings. I mean, you
Okay.
have to look at the whole shebang.
Okay.
You have to look at price to earnings, see where they're trading. You have to kind of synthesize them and put them essentially together. Because looking at the market is like puzzle solving. You have to look at different parts to see how does it fit in. And that's simply just the craft. Because
Okay.
there's one element, which is the craft, doing the DCF, the valuations, looking at the multiples, whether it's EV to EBITDA, whether it's price to earnings, price to book. Then you have to deal with the market itself. As you know, the market is violent. It's not a one-way street. So how do you manage the market as well? That's the art of dealing with the market. So both you have to marry to ensure that you're able to withstand all weather conditions.
Yeah. So what are the top 3 metrics that you would look for?
There's no top 3. There's no
Just
top
like
3.
in general, like for you, if you were looking at
I
something.
mean, you have to look at all. There's no shortcuts. I mean, you look at price to book because we're very much in the industrial space.
Okay.
You look at price to earnings. You look at your DCFs, and you look at the sector itself.
Got it.
Earnings. How fast is the business expected to grow? You have to look at the macros. The macros very much dictates which sectors you want to be in.
We've heard about bottom-up investing or top-down investing, right? What do you do? And if you can differentiate between the two.
We look at both. I mean,
Okay.
like I said, you have to ensure that at least the top down is in place. Because
Okay.
if there's no growth in a sector, then it's not very exciting because then they're not expanding.
Okay.
So there's got to be growth. But again, the beauty of being in India is that the country is growing and it's broad-based. It's broad-based sectors. So the fact that the country is growing generally means that most sectors should grow along with it.
Okay.
If not at the pace of GDP, sometimes faster, sometimes slower,
Slow,
depending on
okay.
the sector. Then you have to look at the bottom up, the actual companies themselves.
Yeah.
So what's so special about them? Are they fairly valued? Are they overvalued? Or is there an opportunity where they're behind the pack or undervalued? Maybe the whole sector is undervalued and there's an inflection coming along. So you have to look at both and really see where is the best inflection point and best overlap between company and sector.
Got it. So let's say if I'm doing a top-down approach, where essentially I look at the macros first and then I choose which companies to invest in.
Yeah.
I have a conviction on a certain sector.
Yeah.
Can I just invest in that particular sector's index fund?
Yes, you can.
That works. Okay.
So, for instance, we took a bet on infrastructure.
Okay.
So there we didn't want to pick one stock, we picked 5.
Okay.
And in fact, that worked out well
Okay.
because they don't all move up at beta of 1. Like
Yeah.
sometimes there's an opportunity. One will move up, you may trim it or even sell it completely and invest into a laggard. That will move up and then you'll see that it's caught up with its peer pack. So you may choose to rotate partially into another one. So that gives you an opportunity to move between the stocks within the same
Okay.
sector.
Okay. So that is also a way of doing
Yeah,
things.
that's also
Got
a
it.
way.
Then you spoke about valuations, DCF.
Yeah,
That's how you value a company.
that's one way.
Yeah. So what is DCF and what are the other ways to value a company?
Oh, wow, this is taking me
Yeah,
back. Oh,
exactly.
boy. So that's discounted cash flows because
Okay.
how do you value a company is essentially what is it expected to generate in terms of cash flows because cash flows essentially is what really counts. That's the hard inflow. So it's essentially, and then you discount it for time. because obviously different businesses have different risks. Let's say it's a utility company and it has a contract for 20 years. Then it has very low risk because it's expected to achieve a certain rate of return. But let's say it's a company that's expanding, that's growth, that has certain assumptions, whether it's a tech company. So there you have a higher discount rate because you're relying more on the assumptions and more that is expected to grow. So again, it depends on the risk and return and the growth rates that effectively come in.
So to simplify it, we first take the cash flows that are expected to earn in the next, let's say, how many
5 years.
5 years.
Plus
right?
a terminal value.
Okay.
Like in perpetuity.
Okay. And then when we are taking the discount factor,
Yeah.
higher risk has a higher discount factor.
Yeah, and yeah.
Okay. And the lower risk has a lower discount factor.
Generally, rule of thumb.
And why is that the case? Why does discount factor differ? Like, let's say, okay, I've put a higher discount factor, which will automatically get the valuation down.
Yeah.
Right? Why is that the case? Why are we doing that?
Because you're relying more on assumptions, or there's certain numbers of risks. Maybe you're looking at a restructuring case, or maybe you're looking at a company that's expected to grow at 30% year on year, but that's a very high number at the end of the day.
Yeah.
So what happens if those growth rates falter? Or generally it's in the tech space. So what happens if there's disruption?
Yeah.
So there's a lot of risk attached to investing in a company that has high number of assumptions. Whereas if you're expecting like a cement company, rule of thumb is going to grow 6% at the rate of GDP. But you can't disrupt cement. There are no alternatives as of today in the mass industry. So effectively, it's very steady state type business. So you can attach it's lower risk.
Okay.
So you can attach a lower, let's say, discount rate.
Okay, got it. And what is the other way of valuing companies, if not DCF?
So of course, the other types of multiples.
Okay.
You can look at, or price to book, price to earnings, EV, EBITDA. So you're looking at general rules of thumbs. Essentially, you could look at what are its peers trading at. Maybe you've identified a company that's trading at multiples lower than its peers. Why is that? Maybe there is no difference. Maybe that's the opportunity where it gets re-rated along with the peer pack.
Okay, got it.
Or you look at maybe there's a down cycle. So generally when there's a down cycle, they get derated. So you say, okay, what's the average price to earnings? So again, you look at those elements as well.
Got it.
Or you look at transactions. Again, maybe a company's been taken over. So that again is part of the evaluations. What is someone willing to pay for the similar type businesses? So again, that's a way of valuing.
Okay. So then the other term that I've heard of is value investing versus momentum investing. How are they different and which one do you prefer more?
Well, we're value guys at heart. Well, that's generally, you've got to be a contrarian. We're looking for like overlooked stocks in general. Because like India has 5,000 listed companies around. We have an investable universe of over 1,400. So we're just looking for a handful that have been overlooked by the market. And generally you're looking for value. That's at our very heart. Something that's been, whether it's overlooked structural growth or all these things that have been overlooked, that hopefully over time, as the earnings are recognized, that is generally the unlock. And it already exists in many cases. Valuation, the intrinsic value already exists. So all we're looking is for the market to recognize it. Whereas momentum or let's say, momentum investing is very much, you're already investing with the winners. So whether it's the Mag 7, these types of stocks, you're investing with stocks that are generally moving upwards. But in that case, again, you're very much reliant on the assumptions because the market has recognized that they're doing very well, that they're growing, but then you are paying a high multiple for that. So at any time, as I mentioned, if the growth falters, then you are at risk of market perception. Because who's to say that NVIDIA is 45 PE? Should it be 60? Should it be 30? And the same with the Google and Amazon. Should it be at that multiple? Should it be lower? Whereas we're sitting at, like I said, 1.2 price to book. So even if the market fell, it could go to 1 times, but that means I'm buying the business at the same cost of what it costs to build the business. If it goes even lower, then I'm buying the business for cheaper than what it costs to build the business. So this is what I mean. That's intrinsic value.
Okay. So momentum investing is essentially if a stock goes up
and you're running with it.
Okay, so you just invest more because you expect that it will continue the momentum.
Yes.
And the same way, if it's going down, you expect it to go down and you invest more.
Well, you invest less.
Sorry, you invest less,
or
right?
Short
You
it
short
or something.
it, correct. But with value investing, you have a conviction and then you bet on it regardless of which direction the market goes.
Exactly.
So that's the way to look at it. Okay.
Yeah.
And when you say contrarian investing, what does that mean?
I mean, why is a stock cheap? Is because people just don't like it. They don't want to invest. Either it's got slow growth currently, or it's undergoing, like in line with that, a very poor business cycle. So people tend to dump a stock if it started to make losses. But as we know, business cycles go up and they come down. But so that's what we're riding. Or it's a business that's been in fallows for a long period of time. But we've noted that there's going to be an inflection, that there's going to be, for instance, we invested in steel pipes, and and for 10 years, the steel pipe business had gone nowhere. And why is this? Because there was a lack of infrastructure programs. Oil and gas was in the dumps. There was overcapacity. But what did we note? We noted 3 to 4 large inflection points, whether it's the infrastructure program for water for all. So India said, I'm going to build pipelines across the country. So that's a huge push.
Yeah.
Gasification. India said we're going to move from 7% to 15% of the gas energy mix. Again, steel pipes. Saudi Arabia building mega developments. It needs water infrastructure. And of course, oil and gas doesn't remain in the shallows for always.
Yeah.
Again, in 2022, it went and reached peak prices. So again, these oil and gas companies are rich. They can do exploration, they can do transportation using steel pipes. So again, effectively, that was like massive inflection points. So then it turned around again.
Got it. Let's say you have invested in a stock, and all of a sudden your conviction changes. What has to happen for your conviction to change? Because you're looking at stock at a long-term perspective, right? So something has to massively change for you to not like it anymore.
Yeah.
What would that be?
It has to be structural. So it can't be, you can't be phased by price movement, because the price doesn't always reflect, obviously, since we're aiming for alpha, it doesn't reflect the structure, the intrinsic value, the actual value. So we don't get phased out by price volatility, because hopefully that's just notional, it's just temporal, it's just temporary. But if there's a structural change to the actual company, that's when we say, how do we get out of this? How do we mitigate our losses? So it's rarely happened, luckily. And essentially, it could happen. Maybe it's a government change in policy that crimps it. Or maybe they have to refinance. So suddenly their back's against the wall and they have to pay higher interest, which is a real capital loss. So multiple things can change your structural business. Or it could be a downturn in the actual business itself. So we say, do we want to sit there for 2-3 years?
Yeah.
Not really. So again, we may want to exit.
Got it. So let's say, what are the top 3 red flags that you would see in a stock?
Of course, you've got to be cognizant of corporate governance.
Okay.
So we do our
governance
looks.
Is a bit, okay.
Yeah, we look around and we say, we speak to analysts. What is this promoter like? We look at the financials. Do they make sense? Are they in line with their peer group? So we look at the financials.
Okay.
Are they in line with peer group? Do they make sense? And many things. We've been in the market. Ricky's been in the market for 30 years. So he's got a pretty good handle of different promoter families. What is their reputation like? And that's one very important thing. But of course, you have to be cognizant, because essentially it's not a complete red flag, because India isn't like the easiest place to enter. True. And these guys are the outliers. So essentially, to be an outlier in India doesn't mean you have the greenest fingers. You've got to be part of the system.
Yeah.
So you take it with your stride, essentially. You don't say, I'm totally out. You say, okay, I recognize it, and I will taper my investment accordingly. Okay. And that's why you're diversified as well.
Okay, got it.
Secondly, another red flag is if we don't know the business. So essentially, we like to do what we know. You know, like Peter Lynch says, do what you know.
Yeah.
And we do very basic businesses. Why at First Water are we very much in industrials? We are in basic, boring sometimes businesses because they're easy. It's easy to understand steel, cement, steel pipes, chemicals. Very simple to understand. So no one will really have an edge over you in the market. But if suddenly we go into biotech and whatever, AI and tech, then we're in a world that someone else is better than us.
Yeah.
What do we know about clinical trials 1, 2, and 3? Nobody's a PhD.
Yeah.
So that's why we stick to our knitting, stick to the basics.
Got it.
Thirdly, liquidity. How can we be active managers? How can we be able to enter and exit? We don't want to be in those micro caps where we have to take block deals, because there you're very hard to enter and you're very hard to exit. You have to be in a liquid stock, and that really is the beautiful part of being in a stock market, is that it gives you liquidity, it gives you that opportunity over and above, like for instance PE, to be an active manager.
Then next one would be, can you, in process, like in the order, tell me how does the process look like for you to do a stock pick?
Wow, that's a good question. But then how can I tell you? Because then you'll start a competing fund.
Yeah, exactly. You're stealing your star recipe.
Well, I'll keep out the actual ingredient.
Yeah.
No, I won't. I'm kidding. Like Coca-Cola.
Yeah.
But essentially, well, it starts at the macro. So that's why we're in India. Why is India important to us? It's not just because I'm Indian or I'm a patriot. It's because we believe we can make pretty good alpha there.
Okay.
And why is that? Because it's growing. It's all these tailwinds, whether it's the fastest growing major economy in the world, whether it's a young economy, whether it's the largest population, whether it's infrastructure spend, all these things are really, whether it's this China +1, China anti-invol, all these things are long-term tailwinds. They're not near-term, not passing phases.
Okay.
They will be with India for 10 to 20 years. So that's giving you some saving grace, that there will be demand across different industries on a broad-based basis. Because that's also the opportunity to be in a broad-based economy, not just a hollow index where you have to be in 5, 6, 7 stocks or nowhere.
Got it.
So that's at the very crux.
Okay.
Then we do our screening process. What is the screening process? We download all 5,000 stocks or whatever.
Oh, wow.
But of course it's screening, so you have to filter very quickly, because obviously, we have a team of 3 people and they can't cover 5,000 stocks. So we start knocking out. We get rid of small caps, not small, but the caps that are below our radar.
Okay.
So then we're flexi cap over a certain range.
Got it.
Then we get rid of sectors that we don't really understand, or that are illiquid, like holding companies. So again, we're filtering out. Then we screen, we look through each one and say, what's this? Corporate governance, knock it out.
Yeah.
As in, like, because we do it on a weekly basis, we got a good handle of them each time. So we're looking for the cheap stocks. What's cheap? Because the stock market can move up and down, and then suddenly every week or once in a while, you find a stock that was well valued, suddenly it's fallen, and say, interesting. What can I do? Why is that? And what can I do with that? So that's why we're screening regularly to see for new ideas. Then you look at the valuations. Are they decent? Are they fair? Are they overvalued? Are they decently valued? And why is that happening? So again, you don't want to be too early in the stock, but that's part of the, you don't want to come in at the beginning of that downturn of a business cycle, let's say bear market. So you're saying, what's happened to this stock? Is it a short-term impact? Or do we have to just monitor the business, continually monitor? So again, you're looking at the valuations, and then you dig deep. What's happened to financial performance? What's the historicals? What is the management saying? You speak to various analysts in the business. Send me your report. You speak to the IR. What's happening with your business? So you're continually just digging and digging. So like I said, you look at the macro. Then you try and identify a handful of stocks. Then you do your due diligence and dig a bit further to say, is there an investment thesis? What is the turnaround? What is the inflection? What's going to impact earnings? And how long will that take?
Yeah. So let's say when you do your screening process, how many stocks are you actually left with based on what you focus on?
I mean, depends. Like, for instance, the last year has been very much a sideways market. It's just been consolidating. India's a tale of two cities. Many people say they look at the index, like today, the index is hitting highs, or this last week, the India's hit highs. but it's a hollow index in India as well, because many of the stocks are actually falling. It's just some stocks are pushing up the index,
Yeah.
the heavyweights. So it depends on where the index or where the market is.
Okay.
Sometimes there are a lot of opportunities, but you can only look at a certain few. So generally, we'll pick up 2 a week
Okay.
between the analyst team.
Okay, so 2 a week, and then you decide what to invest in, what not to invest.
Well, we may disregard them all, but we're just sticking with the process.
Okay.
We're just continuing with our process, our philosophy, and it's a learning point. Sometimes there's so many stocks that you see are undervalued and you want to take a stab at all of them. Sometimes nothing looks good,
Yeah.
but you still got to stick with the process because that's just the way it is.
Yeah. Okay, now this brings me to the hot topic,
Oh,
AI.
okay.
Do you think that at any point in time AI can take over your process?
Yes and no.
Okay, how would that be?
I think AI, of course, is a very important tool that you can augment yourself.
Okay.
Like last year, if you used AI, is very clunky. Half the information
Yeah.
was always wrong. You wouldn't want to use it.
Yeah.
But somehow, maybe 4 or 5 months ago, you looked at it again and you thought, wow, what is this?
Yeah.
You know, last year it was like an 18-year-old school leaver just walking around your office and just saying, what can I do? And if you gave it any work, it would do it wrong and you just have to throw it in the bin. But this year it's like a first-year analyst. It's doing fast. You know, the right prompts. It can even start doing valuations. We're examining that element. It can create reports. It can do, with the right prompts, you can do a lot of work. Of course, it's still, but I think personally, it can maybe replace your first year analyst,
Yeah.
but it can't replace your intuition. It can't deal with shocks,
Yeah.
surprises, because as long as the market is fueled by fear and greed, there should be opportunities. Because again, and it depends on who's prompting it. If you've always been a momentum player
Yeah.
or a consensus player, you will give that prompt and you
Yeah.
will gravitate towards the same style. And if you are contrarian or have a different philosophy, again, your prompts will be different. But again, it's about the art of dealing with the market. So maybe AI can help with the past, looking at historics, building a model, building a report, because here it's collating data, synthesizing and doing a very good job. But same way that someone could build an initiation broker's report is what AI is doing. A very good job. But doesn't mean that same broker who has the information can do a very good job in the market. So can AI do a very good job in the market? I think, again, I reserve the right to be wrong, maybe on the short-term arbitrage, where it's looking at patterns, pattern recognition. But like I said, over the medium to long term, can it really be a contrarian player? Can it deal with a COVID situation, a pandemic? Can it deal with conflict? Again, it has to look at the past. And if there's no precedence, what will it do in that situation? So again, I think human, let's say, intuition should be able to deal with shocks, surprises. What will it do with Donald Trump and his tariffs? Maybe it'll say sell when the market has fallen, say, let's get out because I can't cognate or whatever, I can't compute this. Who knows what it will do?
Yeah.
But at the end of the day, the human has to use his critical thinking, his approach to really counter all these shocks that happen and the fear and the greed.
Got it. What are some of the behavioral mistakes that people make when they're investing in general in any market?
Well, behavioral mistakes, that's a very good question. I guess there's like near-term bias
Okay.
in terms of memory bias.
Okay.
I don't know the actual term, but for instance, the FANGs or the MAG 7,
Yeah.
because they've gone up, it will continue moving up. But as we know, the market isn't always linear. Eventually, things catch up,
Yeah.
essentially. So valuations catch up or they're too frothy. And essentially, sometimes, like Microsoft, from I think 2000 till 2017, you wouldn't have made money.
Yeah.
As in, like, from that period of time, nearly 20 years, had you bought at that peak until for 20 years, you wouldn't have made money. But yet, before 2000, it was like a rocket ship.
Yeah.
And since then, it's also done very well. So things catch up at the end of the day. Valuations is very much the heart. So sometimes people get caught up with stock prices over the actual fundamental business. Two, again, that's fear and greed. So sometimes there's fear in the market. So that's a bias. Many times people do get caught up with the stock price moving up. And if there's a market crash, then they just sell at any price. They sell when they feel pain, not, and because they don't see themselves as owners of a business. They're not looking at the fundamental business. They're simply looking at what they've lost, maybe 10, 20, 30%, sometimes 40. But that's probably the time when you should be buying. And that's why, again, averaging in can help counter that. So two elements. One is you've got to know your business. What is the intrinsic, actual fundamental business?
Yeah.
For instance, let's just give you an example. The Burj Khalifa. Let's just say the Burj Khalifa costs $1 billion to make. Let's say they just listed that entity, that building, on the stock market. And for whatever reason, it's trading at $500 million. Then you say, wow, it's very reasonable. You can't even buy this business. You can't even build this building for 1 billion. Some people, let's say it goes up to 600, then people get excited. It's going up. They may buy it at that. The market may just say, okay, let's take it down to 400 million. At that point, they may sell, but not realizing that actually it's even higher, as in you're buying the same business at a bigger discount.
Yeah.
So again, not understanding what you're actually buying. You really have to see yourself as an owner of a business and understand what is its intrinsic fundamental value.
Yeah. So as a retail investor, like personally, what should I follow regularly to make sure that I'm in awareness of what is happening in fundamentals of the market?
Well,
like some sources I
would just suggest if someone has a full-time job, then he shouldn't be an investor too.
Okay.
Because, as in like, not a stock picker.
Yeah.
Because again, it's about comparative advantage. You're an individual, how much time can you do, commit? Two, you're just learning on your own, without a structure, without a philosophy. You're reading here and there, using AI maybe, what shall I buy? So you're not spending all your time, whereas sometimes you're competing against someone who has a team of analysts, someone who has a philosophy, this is all he does. You know, your comparative advantage is much less. So I would suggest just finding a good fund, take away the effort, and let someone who's do your due diligence. Have they performed over a long period of time? Speak to them if you wish. Understand their philosophy, their approach, and just have a SIP scheme. Just invest gradually, because let them do the work. Let them compete against the market.
Got it. Now I want to know, what was one of the best investments that you made versus the worst one that you made?
Oh, wow, good question. So I mentioned it already, or I haven't actually. A new one I'll give you.
Yes.
So essentially, Polyplex.
Okay.
So there's this company called Polyplex in India, and what does it do? Again, very boring, very basic. Essentially, it makes flexible packaging.
Okay.
So what do I mean by that? So when you buy your meat, your cheese in the supermarket, it's wrapped in flexible packaging.
Okay.
And FMCG in India is a very highly valued space. And why is this? It's because it's growing at 10 to 12%. Because as people get richer, they will gravitate naturally towards branded goods, branded crisps, branded chocolates, toothbrushes, toothpaste. They will move up this Maslow pyramid. And that's why they're growing so fast, this space. But you have to pay the price. Essentially, sometimes they're valued at, Colgate, Unilever, Procter & Gamble. They're sometimes valued at 30, sometimes at 80 PE. So you're paying a high price for that growth. But we looked across the value chain, and we identified flexible packaging, which was trading at, until 2019, it was trading at half of book. And it's in India, it's growing at 10 and 12%. So here you have a company that's in 5 countries around the world. So it's geographically diversified. It was debt-free. In fact, it had $150 million on the books. So even a bad management would find it very hard to bankrupt this business. In India, as I said, it's growing at 10 to 12%. And at one point, it was an alpha player in the world. So Ricky found this stock in the beginning of 2000s, and he bought his first share at 4 rupees.
Oh, wow.
Just 4 rupees. And why did he get interested in this stock? Because from 2002, where it has a single line, 20,000 tons of capacity, in 2010, it had carved out 7% of global capacity.
Oh, wow.
So this was an alpha player globally.
Yeah.
As I mentioned, it's growing fast, it's geographically diversified, it's debt-free, and even in 18, I think it was available at less than 1/3 book. In 19, less than 1/2. So you can buy this business for less than what it costs to build it.
Yeah.
So let's say this company wanted to expand. It would go to a company called Dornier. It would say, here's $90 million ballpark for 70,000 tons of capacity. It would bring it back to India or whichever geography. We will be able to buy this, expand our investment at a rate of 45 million. So we're buying for less than what it costs to build a business. Plus, it has management. It's a long-term business.
Yeah.
It's got blue chip clients, PepsiCo, Unilever, whoever, Armo. So it's got blue chip clients, and we're buying it for less than what it costs to build. What's there not to love? And essentially, he liked this company so much that he bought 23% of the entire company.
Wow.
And by concentrated play, at one point it was 1/3 of his book. And 2022, it peaked at around 2,800 rupees.
From 4 rupees.
From 4 rupees,
to 2,800.
he ran it. Obviously, he didn't buy all of it in one shot.
But yeah,
he's
eventually,
averaged
yeah.
in and he's averaged out. But the beauty is the fund did it as well. So we had 11% of our book in Polyplex. And what happened was at around 500 rupees, because obviously we started
Yeah.
in 1819. So essentially, so we optimally entered. You know, he optimally entered, we optimally entered. So we built in our book. Along comes COVID, whatnot.
Yeah.
Then 2022, it peaks at 2,800. But from 2,000 to 2,800, we slashed our position from 11% to 2 to 3%.
Wow.
So we took it from a heavyweight position to a light to tracking weight position within a quarter. So that means we were lock, stock, and out. We took our money, we've done whatever we wanted, and in hindsight, of course, everything's beautiful in hindsight, we were right, because this time, well, in 2024, the price fell to 700 rupees. So this is what I mean. This is a business cycle. Essentially what happens, because it was experiencing a super cycle, people bring capacity, people bring in cheap
Yeah.
imports. And of course, it turned from a high margin to even negative margin
Yeah.
at that time. So that's what I mean. If we were buy and hold, we would be like crying in our beer, saying we could have sold, we should have sold,
Yeah.
but we're sitting at an average profit. But because we said we weren't greedy, we sold on the way up and sold on the way down. We took off our money and we re-entered the stock again.
Oh, wow. And your worst investment?
Oh, a worst investment. That rarely happens. So yeah, we took a bet on Vodafone. It wasn't actually a bad investment, but our bet was India, before Jio came in, had 12 telecom companies.
Okay.
Along comes Jio. You know, the Reliance came up with a new telecom company. And essentially it was giving at very good rates, phones, data,
packages,
everything. So the pressure was too much on the industry. Here, there's heavy capex. You've got to make a return.
Yeah.
But because he was, the margins had come down, that they weren't able to effectively. So 12 suddenly turned into 2.5 private players. So everyone folded shop because they couldn't sustain the let's say the pricing, the new pricing, all this free stuff coming into the market. They said, we can't remain profitable. We'd rather just say we're out. And Vodafone teamed up with Idea and said, okay, we can't sustain individually, let's merge.
Yeah.
So our bet was that eventually Jio has to raise prices because obviously it's been sustained by the huge petrochem cash flows that are coming through. So it could do all this because it had a cash cow behind it. But other guys are individuals. They don't have cash cows necessarily. So our bet was eventually he's here to make a profit. He will increase margins. But unfortunately, Vodafone was like hit from all angles. First of all, it couldn't sustain, or it's still around, obviously, but it wasn't able to make too much of a profit. It was losing subscribers due to this cheaper rates elsewhere. It was being hit by the Supreme Court. It was in court for various dues, like charges that the government had said you owe us. The Supreme Court said you have to pay interest. So on top of that, it had to pay interest. Thirdly, it had a withholding tax that I had to pay because it was acquired earlier, and then said actually the responsibility lies with you. So there was retrospective taxes that came in play. So many things were either hitting sentiment or the actual balance sheet and the cash flows, and eventually, but we thought, how long can it? As long as it can sustain this, eventually, Geo and the most dominant new player in the block would have to raise its prices, and when that happens, this guy, the pressure would rise, and it should be able to survive, if not flourish. Or at one point, it was so cheap that any big player looking at India, whether it's Amazon or Facebook, saying, I want to enter India in the telecom space and build around that ecosystem, as Reliance is doing with Jio. We thought someone could acquire it. And of course, we thought that the balance sheet was much higher than the market price. So there are multiple ways it could be acquired. The pressure could be taken off. All these elements could come in play. But essentially, it was just knocked about. And eventually we said, we don't want to be knocked about for so long. Let's just cut I think we came out generally flat. But, there are violent notional downside kind of volatility. We said we'd rather just exit. We keep our nerves. We'll live to play another day.
Yeah, got it. So now my last question. What would your advice be to someone who is doing stock market day in and day out?
Choose the right investment philosophy. Read the right books. And be in the game, essentially. The right books. The Intelligent Investor. Peter Lynch. He's written beautiful books. Howard Marks, The Most Important Thing.
Yes, I'm reading that right now.
Oh, it's a classic. Many of these beautiful books, and stick to the right philosophy. Don't listen to other people unless they got a real proven track record, and join the right firm. Because that's the best way of learning and getting a good mentor. Your mentor is the best thing. And just, experiment, try, build your experience, follow, who you think your idols are in the stocks, and build on them.
Okay, so now that you spoke about finding the right mentor and choosing the right company, as someone who's starting out their career in finance in general, right, in investments and stuff, should they go with an already established company, or should they go with someone who's still building out?
No, because the proof is in the pudding. The longer the track, the better you feel that its philosophy and approach will be.
Okay. So you first start with the most established.
Yeah, you start with a good fund, basically. Or just start. You can start anywhere. Like I've meandered. I was an auditor. I went into treasury. I went to corporate finance, PE, public equity. But I found the right person to learn from. So you just got to start with the foundation. Either you can start as an auditor. Don't be too fussy. I think today everyone wants to come and they want to be Gordon Gekko. They come straight from the block and they want to be the Wolf of Wall Street. But just build your foundation and persevere, whether it's do your CA, your CFA, become an equity analyst, try on your own, have that perseverance. The sweat is 99%. As long as you're sweating, you're building out, reading the accounts, looking at the audited, reading the management descriptions, the commentary, just learning. And of course, trying it out. Don't give up, and just build the right philosophy. And that's really you can do. It depends. Can you find the right person? So watch the right people, like I've mentioned quite a few, listen to them. What are they really saying? How are they really attempting to create alpha? And just feed that into your own philosophy and go the distance effectively. There are many ways, because how many people really make it? It's probably just a handful. Just a few percent really come out with that philosophy. As I mentioned, many people just join a franchise and just join a different path. If you look at America, you will see that very few hedge funds have actually beaten the index. So that means even these smart guys, Nobel Prize winners, MBAs, PhDs cannot beat the index. Very few can.
Yeah.
So just find those who have and try and learn
From
what they're
them,
saying, their
yeah.
commentary, and whether they're podcasts, and read these books.
Yeah.
I mean, I'm from the value school of thought, so obviously the intelligent investor is very much the Bible.
Yeah.
Start there and just build out from there.
Got it. Thank you so much for taking the time out. I'm sure people are going to love it. I've learned so much. So really appreciate you taking the time. And
No, thank
thanks a
you,
lot,
Domini. I really
you know.
appreciate you taking time to speak to me, and I really enjoyed myself.
Thank you. Thank you so much.
Thank you.
The views expressed in this podcast are personal opinions, meant for educational purpose only, and do not constitute financial advice. Please consult a licensed financial professional before making any investment decisions.